Good morning, traders, and welcome back from your Easter break. This is your Forex market commentary brought to you by ECN. The return of markets to liquidity and participation will set the underlying tone for the euro-dollar market this week. In addition to that, the release of this week's market moving report that will provide the market with more clarity on whether the ECB will follow through on its aggressive dovish threat. I hope that this commentary will prove to be insightful for you in formulating a successful trading strategy. First, in line with this commentary, we will break down the euro-dollar market on the technical front. The euro-dollar sell-off continued at the beginning of this week's trading session from the 1.3830 zone and breaking below the 1.3800 level despite low volatility and market participations during yesterday's trading session and when the large majority of the Western financial market are closed for the Easter Monday. Nevertheless, investors are expecting volatility to pick back up as volume, liquidity, and market participation is due to return as today's trading session commences. In addition to this week is packed full of market-moving events that will ultimately provide sufficient momentum for the trend follow-through. Ever since the euro-dollar market's second attempt this year to break out from the 1.3900 critical trading level, retail traders have been shorting this pair and as a result once again established the 1.3900 as a short to medium term top for the single currency. As a result of that, this marked the intra-week euro decline from the 1.3900 level back down below the 1.3800. In accordance to the SSI, which is also known as the Speculative Sentiment Index, net retail traders have jumped on every opportunity to short the euro on every advancement. Despite this net short sentiment had leveled off significantly, and there are currently 4 net short euro-dollar positions taken up by retail traders for every 1 long euro-dollar position outstanding. Therefore, analysts are suggesting taking a contrarian view to this extreme crowd sentiment, and this may entail near-term euro-dollar bounce. Analysts are also monitoring the 1.3900 critical resistance level, and in the case that the pair can break out from this junction, by then will the bullish bias return. The euro-dollar pair opened today's Sydney trading session in a narrow congestion at the 1.3792 when this report was written. Analysis of a collection of technical indicators on the hourly interval on the euro-dollar market suggests a temporary bearish market sentiment and recommend short position on the euro. The hourly charts show that the single currency opened today's Sydney trading session inching closer to its established short-term Fibonacci support at 1.3788, while the Fibonacci resistance is set at 1.3798. Ever since the pair broke below the 200-day simple moving average last week trading session, momentum failed to gain traction and the pair continued to trade below the 200-day simple moving average going into this week's trading session. What this entails is that the long-term outlook on the single currency had been downgraded to bearish if the trend continued to trade below the 200-day simple moving average. This trend action holds great significance as 200-day simple moving average contain more or less a 1 year's worth of trading data and it forecasts long-term market sentiment. The bearish long-term market outlook on the euro-dollar pair is also shared by its short-term moving average counterparts, as the euro-dollar pair opened today's Sydney trading session in line with the 5 but below the 10 and 20 and 30-day simple moving average. Collectively, this is indicative of a sell recommendation on the technical front. It is also important to highlight that this week presents itself full of market-moving events that will alter the course of the euro-dollar pair and influence the trend moving forward. On Tuesday, we have the U.S. existing home sale forecast at 4.55 million homes. With Wednesday, we have the German manufacturing PMI forecast at 54. Also, we have the Eurozone manufacturing PMI forecast at 53.0, while the Eurozone service PMI is forecast at 52.4. This data is very important because it either determine whether the ECB will pursue and commit to its aggressive dovish undertone. Over in the United States on Wednesday, we will also expect the U.S. release of its new home sale forecast of 450K. On Thursday, we have the German IFO Business Climate Index forecast at 110.5, while the U.S. core durable goods order month-on-month is forecast as 0.6%. Also on Thursday, the U.S. initial jobless claim is forecast as 310K. Lastly, finishing off this week, we have the Friday U.S. Michigan Consumer Sentiment Index forecast at 83. Moving along to the fundamental front on the euro-dollar market, The past 4 trading session has presented itself as a consolidation session for the euro-dollar market. The euro has fallen down to a level where the ECB official would be comfortable with. However, this would be short-lived as market volatility is expected to pick up, especially surrounding this week German and Eurozone manufacturing and service PMI releases, as well as the IFO business climax. Since key components of the ECB forward guidance mandate are inflation reading and economic growth, an upbeat in PMI reading will reinforce the view that the ECB will scale back its dovish undertone on monetary policy. Ever since the ECB came out and voiced their support for more aggressive easing policy to combat deflation, this prevailing euro bearish theme continued to hang in the balance as the half of the Eurozone leading economic indicators will either negate or validate Draghi's dovish undertone. This impending threat from the ECB to pursue more aggressive easing policy will continue to be the catalyst that play into the euro's downfall. Across the Atlantic in the United States, the recent release of initial jobless claim indicate that the Federal Reserve action to dismantle its QE program have not proven to have a detrimental effect on the US recovery. Nevertheless, the Fed took no chances and continued to reaffirm its stand on keeping interest rate low for an extended period of time. The reason behind this action is to reduce market volatility and avoid jeopardizing the US recovery. I want to thank all of listeners for spending their time with us. Until then, stay tuned for the next commentary, everybody.